Hello and welcome to the July market update. I hope that everyone had a wonderful 4th of July. My name is Dennis Maynard. I am a real estate broker here in the Los Angeles area. I hope that you'll take a moment just to like, subscribe, and follow this channel. Don't forget to leave a comment or a question below. Inflation continues to forge ahead, strong at 9.1%. Energy and food prices continue to dominate along with input and labor prices. Here we see gas prices up 59.9% and natural gas prices up 38.4%. This is largely due to bad policy from the current administration. On this slide, we can see food prices continuing to exceed inflation at 10.4%. This is impacting everyone globally. Over the past few weeks, we have seen some of the basic hedges against inflation falter, including copper, materials, and gold. I believe this is due to shifts in the global currency markets, including the euro and the yen. Commodities, in particular, have an inverse relationship to the dollar. One rises, the other falls. I think this trend will reverse soon for the short term. Inflation is here, and it doesn't go away quickly. The Federal Reserve is beginning to address the situation, and this was largely prompted by the Michigan Inflation Expectation Report posting its highest number since 1981. There are two tools used to do this. The Fed funds rate, also known as the overnight rate, will likely get a 100 basis point hike at the next meeting. The other is reducing the amount of debt held by the Fed, which in turn reduces the money supply. Money supply is increased or decreased when the Fed buys or sells bonds. Quantitative easing, buying bonds, is becoming quantitative tightening, or selling bonds. It is not happening quickly, but it is impacting the global currency markets as mentioned just a moment ago. Effectively, we are shrinking our money supply while other countries are still printing. This in turn causes the dollar to get stronger as we are still the best place to park money. The announcement of these policies has caused a crash in bond prices or a rally in bond yields, and yields are rising quickly. The 10-year Treasury and mortgage rates are loosely correlated. Currently, the 10-year discount yield is at about 4.35%. Mortgage rates for a conforming loan start at 5.5%. There are other loan products available at a lower rate. If you would like more information, please reach out. As interest rates continue to rise, it should have an effect on home prices. I made a video about this called Rising Rates and Home Prices. You can find the link above. The housing market, though, continues to hold up as home prices continue to rise. The number of offers over asking, and sales volume has fallen some. This is causing inventory to grow up to 2.6 months supply, or up 20% nationwide. The big brains are expecting home price appreciation to slow to normal levels over the next few years. In the meantime, delinquency rates are lower than 5%. That's lower than last year. I continue to have the same conversation over and over again. When is the housing market going to crash? Of the total number of homes built in the U.S., 38% of them are owned free and clear with no mortgage. Here is a breakdown of the other 62% of homes with a mortgage. According to CoreLogic, the vast majority of homes with a loan have a loan-to-value ratio of 70% or less. This means that they have 30% or more equity in their homes. In order to have a crash, you need to have massive supply and no demand. We're still in the opposite circumstance, and it is clear that the majority of homeowners don't have to sell. Is it possible that home prices will come down? Sure. To have that, you would need more homeowners willing to sell at a lower price. It's a function of supply and demand. Here we can see construction has continued to lag demand for over 10 years. Without increased supply, we will be hard-pressed to see prices fall dramatically. Potentially, we may see prices fall sooner than later in overheated markets. Los Angeles home prices are slightly off their peak at $990,000. The supply of homes is currently around 2.2 months. This is an increase in supply, but we need to see higher than 6 months supply to have a buyer's market. Condo prices rose to $641,000, and the supply of condos rose to 1.7 months. Both homes and condos have an average of 25 days or less on market, and an average final sale price are still above asking. To sum up, the market is slowing down from interest rate increases, but sales are still happening at a consistent pace. The Fed is moving to combat inflation as gas, food, and production costs continue to rise. Interest rates are likely to continue higher for the foreseeable future. Economic theory suggests that rates will have to get above the inflation rate. During the 1970s, when inflation raged on, housing prices remained stable as rates rose. Here is a chart of the median sale price of homes sold in blue and the mortgage rates in red. It is plain to see that home prices rose along with interest rates rising. If we use history as a guide, home prices should remain stable in the coming years. If you're thinking about buying or selling a home in the Los Angeles area, please give me a call. I'd be happy to discuss your home ownership goals. My team is ready to help. I look forward to seeing you on the next Market Update.